Ever wondered why the market suddenly stops and reverses? It might look random, but it's not. Price moves with a purpose, reacting at key levels that you can learn to identify. Stick around, and I'll show you exactly how to find and draw these levels to transform your trading. So, what are these magical levels? They're called support and resistance. Think of support as a floor that stops the price from falling further. It's where buyers step in and push the price back up. Resistance is the opposite. It's like a ceiling where sellers take control and stop the price from rising higher. When you see the price bounce off these areas, you're witnessing support and resistance in action. Simple, right? But incredibly powerful. Now, how do you actually find them? The first step is to look for swing highs and swing lows on your chart. A swing high is a peak where the price turned down, and a swing low is a valley where it turned back up. Don't just pick any peak or valley. You want to find areas where the price has reacted multiple times. If you see the price bouncing off the same level 2, 3, or even more times, that's a strong clue you found a significant support or resistance level. The more reactions, the stronger the level. Here's a pro tip. Stop thinking of these as exact lines. Markets are messy, and price rarely stops at the precise same penny. Instead, think of them as zones or areas. When you spot a level, draw a small horizontal box or a shaded zone around it. This captures the general area where buyers or sellers are active. This simple shift from lines to zones will prevent you from getting faked out by small overshoots and give you a much more realistic view of the market. To find the most powerful levels, you need to zoom out. Levels identified on higher timeframes, like the 4-hour or the daily chart, are far more significant than those on a 5-minute chart. Why? Because they represent a larger consensus of market participants over a longer period. So, always start your analysis on a higher time frame to identify the major support and resistance zones. These will act as your trading map. Another cool thing about these levels is that they can flip roles. When the price finally breaks through a strong resistance level, that old ceiling often becomes a new floor. This is called a role reversal. The market now sees that previous resistance as a new support level. The same happens when support breaks, it can turn into resistance. Watching for these flips is a key skill for identifying future trade opportunities. Before you go, let's talk about a common mistake. Many beginners clutter their charts with dozens of lines, making it impossible to see what's actually important. Less is more. Focus only on the most obvious, well-respected levels that have multiple touches. A clean chart leads to clear thinking and better decisions. By mastering support and resistance, you're no longer guessing. You're trading with structure, confidence, and a clear plan. It's one of the most fundamental skills in trading, and now you have the tools to start practicing. If you found this helpful, hit that like button and subscribe for more tips to help you trade smarter. Thanks for watching, and see you in the next video.